Hello, in this video we'll take a look at an 887% SPY 0 DTE options trade using one indicator plus one free tool. In this video I'll break down the exact SPY 0 DTE option strategy used during the April 2nd, 2026 trading session, including how a massive gap down open turned into a high probability bullish move that delivered explosive percentage gains on out of the money calls as well as at the money calls. This is a rules-based, repeatable SPY day trading framework built around daily market structure, key support and resistance levels, real-time market scenarios, market structure analysis, and precision entries with confirmation. The entire session is traded using the day trading GPS, stocks, ETFs, daily key levels V 3.0 indicator, plus one free trading tool that we'll also take a look at. We'll first take a look at the three normal option plays. One was a $3.22 entry, which turned into $11.56. The second was a $2.62 entry to $10.67, and the third was a $2.09 entry to $9.78. Lastly, we'll take a look at two early session lotto option plays. One was a 91 cents entry that went to $7.26, and the final one is one that was a 66 cents entry that went to $6.52. Hello, in today's video, we'll be taking a look at the Thursday, April 2nd, 2026 trading session for the SPY. We'll be utilizing the day trading GPS, stocks, ETFs, daily key levels V 3.0 indicator, which was just released about 10 days ago, along with one free tool, Annie's Ribbon, which is a ribbon indicator, which is free on TradingView. Okay, in today's session, we have a very large gap down to start off the session at the 9:30 a.m. open, primarily due to the overnight session and pre-market session action in which the ES futures sold off quite dramatically in response to President Trump's speech last night regarding the continuation of the Iran war. Then we saw oil prices spiking overnight and continuing upward up until today's open, and then consequently, as a result of that, we had a major sell-off overnight in ES futures as well as the pre-market. As you can see here, we have the entire pre-market high to pre-market low range below YDL. So with this particular indicator, you also get a market scenario analysis every day at the 9:30 a.m. open at the first tick, in which we have a full gap below. A full gap below means the entire pre-market range, PML to PMH, is below yesterday's low. Compare that to other gaps where you may have the open of the 9:30 a.m. RTH session opening below yesterday's low. But there are other types of gaps where the pre-market high to pre-market low range itself is not entirely below yesterday's daily low. Only the open of the RTH session is below yesterday's daily low. So this is more of a true gap where the entire pre-market range is below yesterday's low as compared to just the open being below yesterday's low. So with this indicator, you have the market scenario analysis here, MS3 full gap below. However, you also have the market scenario analysis table, which we'll take a look at now. Okay, so you enable the market scenario analysis table and it will show up on your chart on the first tick of the 9:30 a.m. RTH open. And here you can see there's a further explanation of what this market scenario means, as well as tendencies, key trading characteristics, and things to watch out for, and things that are typical in this type of market scenario. There are only 6 different market scenarios the SPY can open in every day, and that's based on the relationship between the YDH level, the YDL level, the PMH level, and the PML level. So based on the relationship of those 4 levels each trading day, there are only 6 different market scenarios that SPY or any other symbol can open up in. So the indicator automatically does an analysis of those levels and not only gives you the market scenario here, but if you turn on the table, then you also have the market scenario analysis for this particular session, which will have a further explanation as well as the key trading characteristics and dominant tendencies of this of the particular market scenario that is in effect for today's session. And so as you can see here, we have market often rallies towards YDL to fill the gap. Initial bounce, early buying attempts common as bargain hunters step in. So it is very common with this type of gap situation to try to trade back at least to the YDL level. And so here, as you can see, we had the open down here, and then here is the YDL level. Now with this indicator, you have a 9:30 a.m. opening candle alert on the BBKPL level. That is short for the bull bear key price level, which for here is for today's session 645.74. So we have this opening candle alert. The opening candle alert for the BBKPL level will only fire and show on your chart if it is within the acceptable range for taking a bullish or bearish trade off of the BBKPL. So on a close above, on the opening candle, on the chart time frame that you're on, uh, if you're seeing this label here, that means it is within the acceptable range. In this case, it is a bullish signal, meaning a bullish entry signal. If this close was below the bull bear KPL and within the acceptable range, then you would see a red label on the close of the 9:30 a.m. candle, giving you a bearish entry signal. However, we use a free tool to help confirm the entries, and that is one of two ribbons. One is called Annie's ribbon. There is another one that we've shown on our other videos, which is very similar to this, which is called the Madrid ribbon, which is the original ribbon. Both of those are free on TradingView. The Annie's ribbon is a little bit better in our opinion, only because it does also have a slight nuance differences from the Madrid ribbon, including these two thick MA lines within the whole MA ribbon. So what you're looking for with this is you're looking for confirmation of this bullish entry signal from the stocks ETFs daily key levels V3.0. So on this opening candle, you have a bullish signal. Here you have the entire ribbon. As you can see at the close of this candle, the entire ribbon is green. So that's giving us an additional confirmation of the bullish entry signal here from the V3.0 indicator. If instead this was a multicolored ribbon and was just partially green and partially red, then that would be your caution to not take the trade, because in that case you're getting a conflicting signal. Or on the other hand, if we had a red ribbon, a completely red ribbon with a green bullish signal from the 9:30 a.m. opening candle from the V3.0 indicator, then that would definitely negate that trade. And then what you'd be looking for is for alignment of these signals later on in the session before taking any trades. On this particular trade with this indicator on a bullish trade from the bull bear KPL level, you have two different stop losses that you can choose from. One is the tight stop loss, which would be the QL level below the level that you're basing the trade on. In this case, that is the bull bear KPL level. So the QL below the bull bear KPL would be your tight stop loss if you prefer to take a tight stop loss. As you can see here on this trade, it came up short of the tight stop loss, so that tight stop loss was not hit. The preferred stop loss is the standard stop loss, and the standard stop loss with this indicator is on bullish trades, it will be the first midpoint below the main key level that you're taking the bullish trade from. So in this case, the first midpoint level below the bull bear KPL level that we're taking the trade from, the bullish trade from, is the mid BBKPLS1. As you can see, that was never even close in this particular situation. It is preferred strategy to use the standard SL. However, that is up to each individual trader to decide for their own risk profile, which is better for them through practice of using the indicator. Now, as far as option strike selection, as you remember, we're going to take a look today at something a little bit different than we normally do. We're going to take a look at both the standard strikes that you have as your options on any particular bullish or bearish trade with this indicator, but we're also going to be looking at the strikes uh, in the particular market scenario that we're in. And if we remember from looking at the market scenario analysis table that one of the key trading characteristics of this particular market scenario is a tendency to try to trade back up to the YDL level. So in this case, we'll be taking a look at two additional strikes on a separate screen here in a few minutes of taking a strike at the YDL level, the strike closest to that, which in this case for SPY would be the 652 call. And then also looking at the R2 level, which is close in proximity to this YDL level as well, and that would be the 651 call, as that is the closest strike to the R2 level. Now, the normal strikes outside of looking at the levels from the market scenario analysis table, which happen to deal with the YDL, YDH, PMH, and PML levels, are the strikes from the main key level trades here off of the bull bear KPL. How you determine those, if you watched our other videos, is basically there's three strikes that you can use. The standard play is going to be the strike closest to the main key level that you're taking the trade off of. In this case, that is the bull bear KPL, 645.74. So the closest strike to that is the 646 strike. You look one midpoint above the level you're taking the trade from to get your first out of the money strike. So here, that would be this level, 647.09. So that would be the 647 call strike in this particular session. The final OTM strike for this particular trade would be one full level above, since it's a bullish trade. R1 648.43. The closest strike to that is going to be the 648 strike. Now here we have the 9:30 a.m. ask prices for the 9:30 a.m. candle close. We're on a 2-minute chart with SPY, a little bit different than SPX. SPY, you can use anything from a 1 minute to a 5 minute. It just really depends on your preference. However, we're going to go with the same 2-minute chart that we use on SPX, as we have found that that is the most consistent performer with SPX, and SPY mirrors the liquidity of SPX. So it's basically the same instrument, just done in a different fashion. So the SPY is just basically a mathematical formula of the SPX, but basically you're trading the same instrument, just using a different vehicle, the SPY versus the SPX, and of course that would be the same with ES futures. You're just trading a different vehicle futures. It's basically the same instrument and the same liquidity. Okay, so here we have, we'll just move these over a little bit. So here we have the 9:30 a.m. The ask on the 646 is $3.22. The ask on the 647, $2.62, and the ask on the 648, $2.09. Now with this particular indicator, you can either take a scalp trade. A scalp trade is a one level move in your favor, and that is derived from The level that you're basing the trade on, in this case the bull bear KPL, the direction of the trade is up since it's a bullish trade. One level up is the R1 level. So on a hit of the 9:52 a.m. candle here, we have a hit of the R1 level. That would be your scalp only exit for exiting if you're only doing a scalp. So here we have bid prices on the 9:52 a.m. candle close. Close 383. Remember we paid 322. On the 647s, the bid on the close 318. That's a move up from 262. And on the out of the money 648, the bid on the candle close 257 after a purchase at 209. Now the other type of trade that you can do with this indicator is called a regular trade. A regular trade, you're looking for a minimum 1.5 level move in your favor. And on a regular trade, you have the same 100% exit as an option if you prefer to do that. However, the main point of a regular trade is not only the additional profit structure if you're going to do 100% exit, but also having several other options available to you once it meets the minimum 1.5 level move threshold in your favor. And that is one of several options. So the other options, besides just exiting 100% of your contracts at the 1.5 level move, which in this case, a 1.5 level move is going to be a hit of the mid R1, R2 level. So we have one level move here, move these back, one level move here up to R1. The next midpoint above that is the mid R1, R2. Now that hit occurs on the 958 aim candle, which is right here. So we have it spikes above, hits, goes above PMH, but also spikes above and touches the mid R1, R2 level. So here on that, we have the bid on the close of this candle. As you see, it did back off slightly off of that level on the close. So the closing level is going to be a little bit lower than the high, which was the spike on this wick here. But we're going by the close of the candle. The close 478. Again, we were in at 322. So the bid on the close of the 646, 478. The bid on the close of the 647, 404. That's up from 262. The bid on the 648 close 336. That's up from 209. Now the other options you have on a regular trade, if you don't want to exit 100%, is going to involve a couple of different things. It depends on how many contracts you're trading, how many call options you're trading in this case. So the other options are you can adjust your stop loss to break even, or break even plus a small profit buffer on top of break even. So, but moving your stop loss to break even means it does not mean moving your stop loss to the bull bear key price level that we're basing the trade on. It means changing from a stop loss based on levels to a stop loss based on the price that you paid for the option. So that would be break even. Adding a additional profit buffer on top of break even would be adding an additional amount to break even. So break even on this would be moving your stop to 322. On this one, moving your stop to 262, and on this one, moving your stop to 209. If you're adding an additional profit buffer such as 10%, then you'd be adding, again, we're at this level here when we're doing this, because this was the scalp only exit. Adding about 10%, so adding about 30 cents here, about 25 cents here, and then adding about 20 cents here if you're just adding 10%. The idea then is to keep riding up as the trade continues to move in your favor. Then at each additional key level move in your favor, then you can either further adjust your stop loss or start taking off contracts, or a combination of both. That would be move up to R2, then I move up to YDL, then I move up to this level here, then I move up to YDC, then I move up to R3, and then I move up to YDH. These levels here, these contextual levels, come into play after the 1.5 level move in your favor if they happen to fall within that map. after the 1.5 level move here. In today's session, they do happen to fall. You have 3 that occur afterwards. So those are also additional waypoints. Normally, if these were not in the path after the 1.5 level move there, then you would just be looking at the main key levels and the midpoint levels afterwards. The last option that you have would only apply if you're trading 3 or more option contracts, and that is scaling out of 60 to 90% of your original position and on the 1.5 level move in your favor. So you'd be closing out and exiting somewhere between 60 to 90%. So if you were trading 5 contracts as an example, then exiting 3 would be 60%, exiting 4 would be 80%. If you're trading 10, exiting 6 would be 60%, exiting 7, 70%, exiting 8, 80%, exiting 9, 90%. Then the idea is that you are capturing the profit from that 60 to 90% exit at the 1.5 level move in your favor. And then what you are doing with the remaining runner position is you are adjusting your stop loss to break even or break even plus initial small profit buffer on those remaining runners. And then what you're doing is you have de-risked the remaining runners. You have captured the majority of the profit out of the initial position. And then the idea is that you want to manage those runners, trying to capture as much as the continuation move as possible by doing the same process that we discussed, which is further adjusting your stop loss and or closing out any some or all of remaining contracts at further moves in your favor. Okay, so we had YDL. Remember, we had the YDL as the target, as the dominant target. That is a typical tendency with this particular market scenario that we find ourselves in today. So that is ultimately what we're looking for, and anything above that is just additional gravy as far as any runners that we may have left over. So on the 10:32 a.m. candle here, which is this candle right here, we have a hit of the R2 level, the next key level move up, and we have a hit of the YDL level. So we have a completion of the move from what we saw in the market scenario analysis up to the YDL level. The 10:32 a.m. Bids here, we have the 646, the bid on the close of this 10:32 a.m. candle, $6.88. Remember, that was a start from 322. The 647, the bid on the candle close 601. Remember, that was a start from 262. And then the bid on the 648, 517, that's from a start of 209. Now in the 10:36 a.m. candle here, we had a large spike up, which not only takes out the next level above, the mid R2, R3, but also takes out YDC and R3, and nearly also touches the YDH, yesterday's daily high. So on this 10:36 a.m. Candle here, you can see the value of at least having one remaining runner or having multiple remaining runners that you continue to manage that are de-risked completely from the initial 1.5 level move in your favor. Because then you can take advantage when you have moves like these happen as a continuation with either at least one remaining runner. So here in the 10:36 a.m. candle, we have a bid on the close of this candle here of 11.56. Remember, this started out at 322. The 647 bid on the candle close 10.67. Remember, that started at 262. The bid on the candle close here of the 648, 978. Remember, that started at 209. Next, we're going to take a look at the 651 and 652 calls. So this would be a situation where you're already getting the market scenario analysis table where it's telling you that YDL is the dominant tendency with this. That doesn't mean it's 100%. It just means that it is the dominant trading tendency of this market scenario to try to trade back up to YDL. So next we'll take a look on a different chart with these call options for this. Okay, so now we're going to look at the other two strikes, the 652 strike and the 651 strike. So the 652 strike was for the excuse me, the YDL level, which, as we talked about earlier in the video, was for the market scenario analysis table. This was the most common dominant tendency of trading back up to YDL in this particular market scenario. The R2 level also makes sense because it is somewhat in confluence with the YDL, and a two-level move from the bull bear KPL is also the minimum ideal move. So since it is situated before the YDL, it also makes sense in this particular session for this particular market scenario. Now, normally we talk about the three option strikes that you have that we already went over. That is the standard play, the closest strike to the level that you're basing the trade on. In this case, it was the bull bear key price level, and the bullish trade off of that level with the first out of the money strike, the first midpoint above, the closest strike to that level, and then the furthest out of the money, the R1, one level away. However, for situations such as this, where you have a clear dominant tendency for a move back up to YDL, it can make sense to go out of the box here and look at some further out of the money options. Now, one thing to keep in mind on further out of the money options, especially if you're trading 0 DTE options on something like SPY, is that you're looking for the move to happen in the first part of the morning session. So holding these options later on in the session can become something that you need to be very cautious about, because if they're that far out of the money, they will rapidly lose value along with the time decay loss later on in the session a lot more rapidly than options that are closer in. So that's one thing to keep in mind. However, a pro side of using these in general is the cost basis is going to be a lot less. So you can look at it a couple different ways. If you would rather play options for a particular move, whether it's a bullish or bearish move, and you're going all the way out to R2 or to a contextual level that is near an R2 level, or let's say this was the reverse and we had a bearish play and we were looking at an S2 level and perhaps a contextual level that was near or in confluence with the S2 level. The thing you want to keep in mind with these plays, you can look at them as sort of early session lotto option plays. And what I mean by that is that the cost basis is generally going to be a lot less. So the total amount of money that you have potentially at risk is going to be a lot less because of the cost being less. And since we're buying options, we're not selling options. We're simply buying calls or buying puts. The worst case scenario is the cost of the option. So that's one way to look at options. You can have your stop loss level on your options. However, in reality, the total amount of risk is always going to be the amount of the total price of the option, because you can have situations arise, especially with the current president that we have and the current situation that we have, that you can have intraday news flashes that can cause tremendous surges in either direction to happen instantly. And so sometimes, even if you have stops, it can blow through your stops if you get a incredibly rapid move based on some kind of flash news coming out. So that's always something to be aware of with options, is that even with stops in place inter-session, you can have a situation where uh, the SPY is not going to get halted, but you can have a situation where they come out and say the war's over with, or they come out and say we're ramping up and we're going to go in with ground troops, or things are a lot worse than they were, or things are a lot better, or what have you. Whatever the case is, a bomb goes off, some oil refinery gets bombed, or whatever the major news is, you can get a temporary spike in either direction, which can sometimes on SPY you could have a move of 4 or 5 points in a candle, and so that's something that you have to be aware of as far as any stop losses, that in some sort of flash situation like that, it can blow through your stop, and then you're just basically stopped out at the next best price in that particular type of situation. In normal market situations, that's not really something to be concerned with, and we just have a normal ebb and flow market. That's not going to be the situation. It just happens to be in the current situation that we're in with the war and the oil prices and so many uncertainties going on. That's something they need to be aware of, at least for the current environment. Okay, so here at the 930 candle, the 2-minute candle close, we have the 651, we have the close of 91 cents as the ask on the close of this 9:30 a.m. candle at 9:32 a.m. and the 652s closing at 66 cents. Now on this dip move back down, as you see here, we did not hit either the tight stop loss. It came close but did not touch it, nor did we come close to the standard stop loss. So in either case, there was no stop out. However, on these types of options, you are going to see quite a percentage drop because they're so far out of the money. So these dipping back down in here might lose about 40% of their value or so in the first part of the session here. So this one that's 91 cents back down here would be more like 40 to 50 cents, and this 66 cents on this dip back down in here would be more in the 30 to 40 cent range. So buying on the close of this candle here, though, on the getting both the bull bear KPL bullish entry signal here, as well as the ribbon being all green here. We're entering on the close of this candle, so those are the prices. But just something I want to make you aware of as far as when you're using these types of options that are that far out, whether it's a bullish play and they're that far out in this direction, or it's a bearish play and they were that far out and on the other direction. That's kind of how these types of further out of the money options typically react in the first part of this session. Okay, so here at the 952, just like the other options we saw in the previous chart, we have the R1, we have the scalp only exit here. So if you were using these options and you were just looking for a scalp only trade at 952, you have the bid here on the candle close, $1.20 from this. So at 91 cents, that's a good 30-cent profit. So that's basically about a little bit more than 30% here. The 652s are 90 cents. So that's about a 24 cent gain here. So that is more in the 40-ish% range. Now here at the 9:58 a.m., then we do have that wick touch of the mid R1, R2. So that's your regular trade 1.5 level move. Here on the close of that candle, after it backed off some after touching that level, you have on the 651s $1.69. So again, we're starting at 91, so that's approaching a double. Here on the 652s, we have $1.29, so that is pretty close to a double there. Here at the 10:32 a.m. candle, which is this candle here, we have a hit of both the R2 and the YDL. So if you were looking for just the move back up to YDL, this would be your final exit here. 651 on that candle, bid on the close of that candle, $2.93. Again, that started at 91 cents. So that is quite a percentage move on that one. As you can see, the percentage gains on these are going to be a lot more than using the standard and the other two regular out of the money options, because they're going to cost a lot more to begin with. So especially early on in the session, as we talked about, that these can rapidly gain percentage wise. The 652 is $2.32. Remember, that started at 66 cents. Then we have this temporary blow off top here at the 1036, where we went and blew through yesterday's daily close and then through R3 and then almost made it to YDH on this particular candle here on the wick. Here you have, as you can see on the wick, it went as high as 789 on the 651, but again, starting at 91 cents. On the close here, it backed off and $7.26. So starting at 91 cents, that is about a 600 to 700% move there. 652 bid on the $6.52 is the bid on the 652 call option here. Again, that started at 66 cents. So that's almost a 10 bagger there. So as you can see, there are some advantages to using these further out of the money options, especially on SPY. However, as we talked about, it's best to look at these as sort of early session lottos. You do have your stop losses here, just like because you're taking the same, you're basing the trade off the same level. So these would still be your initial entry stop losses. You can still, on the regular trade, adjust your stop loss to break even or break even plus a small profit buffer, and then continue to ride up, whether you're going to have all of your options intact and you just adjusted the stop loss, or if you had multiple options that you were scaling 60 to 90% out of, and then basically managing remaining runners. So you can see the value of having remaining de-risked runners when you can get a substantial move like this. This is really just a 3-candle move here, which was quite a substantial move. So you can see the value in if you have de-risked remaining runners, what can happen in your favor with those. And of course, it's the same process at the 1.5 level move in your favor. If you just prefer at that point just to exit 100%, if you're doing a regular trade, and not adjust your stop loss and hold on to all options, or not scale out 60 to 90% and then adjust the stop loss on remaining runners, that's fine as well. That's up for every trader to decide, but that's basically the process of how you do it with the daily key level strategy and the stocks ETFs indicator. So it works basically just like the NASDAQ NDX indicator and the SPX indicator in that aspect, as far as regular trades versus scalp only trades. Now, for those of you that are interested in trying out this indicator, starting today, we're introducing new monthly subscriptions on all of our daily key levels indicators. So the monthly subscription fee is $150. They are month-by-month subscriptions, which means that you can try it out for a month. If you want to switch to a different plan after a month, we also offer a quarterly plan, an annual plan, and we have our one payment for lifetime access plan. But the monthly plan now allows people to try out the indicator for a month, any one of the indicators, to see if they like it, for $150. And if they would just want to continue a monthly subscription, that is fine as well. You can just continue your monthly subscription. If you decide that it's not for you and we're going to cancel it, then you just need to cancel before the second payment is due. So that is on a month by month. The quarterly is quarterly by quarterly, and the annual is 12 months, every 12 months. The one payment for lifetime access provides the best value. That's one payment for lifetime access. We do provide discount promo codes. However, we do not provide discount promo codes on any of the monthly, quarterly, or annual subscriptions. The discount promo codes that we offer, if you would like to email us at daytradinggps@gmail.com to request a discount promo code, those are for one payment for lifetime access plans. Now the links for our indicators are going to be in the description of this video, and you can also find them in the pinned comment of this video. If you're wondering how these daily key levels indicators are working out for the people who have already bought them and use them on a daily basis, we'd like to show you some of the trader feedback from users of the indicators, and you can also see their comments and reviews that they've left on our wap.com site, which if you click on any of the links for any of the indicators, you can then click on the reviews and review them that way as well. So right now we'll just go ahead and show you the reviews and their feedback, and we thank you again for taking the time to watch this video and wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.